If you've ever thought about buying a rental property, but the bank told you, sorry, your income doesn't qualify you for that, then this video is for you. So a DSCR loan doesn't care about your income because there is no income on the application. It doesn't care about tax returns. It doesn't care about W-2’s. All it cares about is, does the property pay for itself? So a lot of investors that I'm working with right now are using DSCR loans not only to buy properties, but also to take cash out of existing properties to do other things, whether that's buy another rental property. I have an investor right now that's taking cash out to do improvements on a few of his other properties. So today, what I'm going to do is I'm going to talk about everything DSCR loan related. How you qualify, what the properties need to be like, what the required down payment is, what the credit scores are, how the DSCR ratio is calculated, and what that even is, a DSCR ratio. So let's get right into it. So in general, a DSCR loan only cares about your credit score, and it cares about the down payment, a percentage down payment, and it cares how much the fair market rent is for the property. So let's just go through those things at first. The minimum down payment is 15%. And now those products really just came out because it's always traditionally been 20%. So 15% is going to have the highest interest rate, and it's going to require the highest credit score. So in all intents and purposes, I would say you should really plan on 20% and ideally 25% down to really make it, the best deal possible. You can get loan amounts. So I'm doing a mortgage right now. It's a $1.5 million property. They're putting 25% down. And actually, that interest rate, now this is being recorded in middle April, is under 7%. Now, we have to talk about another thing, which is prepayment penalties, but we'll get into that in a minute. So credit score, the minimum credit score is a 620. Now, that's not going to have a good interest rate, and it's going to require probably 30% down, but it is possible. I would say you really want, honestly, to be looking at a 680 credit score, to make it to where you can have a pretty decent deal. So really, these loans are for people that understand investment, right? So they understand that you're going to have to put a down payment down. It's not going to be the cheapest loan in the world. There are points and fees on these loans. And the reason that really is because these aren't conventional government-backed loans. These are loans that are typically offered by hedge funds, people that are obviously looking for a return on their money. And actually, I used to work for a company called Angel Oak, and they were some of the first people after the 2008 crisis to come out with these alternative income loans. And so they would talk to us about, what the portfolio, how it performed. And what was interesting was, of all the kinds of loans they were doing, and we're talking about loans where you use your bank statements and alternative income loans, these DSCR loans always had the best performance. In other words, people weren't defaulting on these loans. So even though there's no income on it, people weren't defaulting. So these are really good quality loans. That's a little bit of a sidetrack, but that tells you a little bit about why would they do this. Because it's a great investment for them. So I'm just going to look at my notes, want to make sure I'm covering everything. So what does DSCR even stand for? It stands for Debt Service Coverage Ratio, which means that the mortgage payment is at least enough to cover, the fair market rent on the property is at least enough to cover the mortgage payment. So a debt service, they always talk about DSCR ratio. So ideally, you're looking for 1-to-1. In other words, if the mortgage payment's $1,000, the fair market rent is $1,000. Now, you can go below that. that you can go down to a 0.75, which means that the mortgage payment could be slightly higher, but that's probably going to have a lower loan to value. In other words, require more down payment. But it is possible. I've done a number of those. There's also one that is a no ratio. Now, what no ratio means is they really don't care what the fair market rent is. Now, that's again going to have a larger down payment requirement, but again, it's possible. I always say to people, with money and credit, almost anything's possible. And maybe that's a good example of it here. So how do they determine what the fair market rent is? So traditionally, the appraiser is going to do a rental income analysis. They're going to look for and do a report. It's on a Fannie Mae appraisal form of 4 to 5 rental properties in the area and what they're currently renting for. And they're just going to take an average. And that's the traditional way to do it. Now, I do work with some investors that use something called an AirDNA analysis. So AirDNA is actually a website. I'll put it in the comments down here. It's kind of like, well, basically what it does is you put an address in, and it's going to tell you the number of days that property should expect to rent each month and the average nightly rent. And this almost always comes up to be more than what the long-term rent would be. And so actually that's what I'm using on this over $1 million loan. And that works out really great. So, and you can go, it's free to create an account. You can put an address in and it'll tell you, what it is. So that's a really cool feature. So I covered the no ratio, the traditional way they do it, from the rental analysis and the AirDNA income. We talked about the max loan to value. In other words, the minimum down payment is 15%. Now, the more you put down, obviously, the better the interest rate. I've found that once you put 40% down, the interest rate's not going to get any better. And also, these loans, because they're really technically business loans, they're allowed to have prepayment penalties. And you can have anywhere from 0 prepay, in other words, no years of prepayment, all the way to 1, 2, 3, 4, and then usually the max is a 5-year prepayment penalty. And a prepayment is usually 6 months of interest on the loan. So if you pay the loan off early, you're going to owe them 6 months of interest. But in return, you're going to have a better interest rate, no doubt about it. So if you plan on keeping it a long time, it's probably, or it could be worth it. So that's good. Now, the points and fees on these, you're probably going to expect to pay 2 percentage points on these loans. So a percentage point is 1% of the loan amount. So I would just say keep that in mind. Some lenders do offer loans with no points, but you're just going to have a higher interest rate. So you're either paying for it now or you're paying for it later. So that's something to keep in mind. And what types of properties? So typically, I've noticed that there's going to be a maximum acreage. They're not looking to do one of these types of loans on a farm, for example. It might be max of 10 acres, maybe even less than that. Ideally what they're looking for are, properties in neighborhoods. Now, and they also are going to have to be in obviously good shape. So you can't have a home that's in disrepair. It's going to have to pass an appraisal, and somebody's going to have to be able to move in. It's not going to be as stringent as like an FHA or VA appraisal, but more like a conventional appraisal. In other words, it can have, ugly paint, peeling paint, things like that, but it just can't be in bad shape. They'll also do these on typically up to 4-unit properties. So you could do it on a quadruplex, a duplex. You can do it on a condominium. There are investors that'll do these on up to like 8-unit, like small apartment buildings. There's a little niche. What they won't do them on, they're not, well, I take that back. There is an investor that'll do manufactured homes. I wouldn't probably go out and try and create a portfolio of those, but it is possible. They're not probably going to do anything on any sort of log cabin or some odd property type. They're looking for something that is going to rent easily. So yeah, but really to sort of wrap that up. And now another thing I want to talk about is cash out. So a lot of people, I'm doing a lot of these right now because people have a lot of equity in their homes in these rental properties and they want to access it. So you can take cash out usually up to 70 to 75% of the fair market value of the home. And it works exactly the same way, so as long as the fair market rent covers the mortgage payment, you're going to be okay. And really they're priced about the same. The interest rates are about the same on a cash out as it is on a purchase, where that's typically not the case on a regular mortgage. So anyway, I hope you found this video helpful. If you're thinking about getting a DSCR loan, reach out to me on my website, mortgagesbyscott.com. Obviously put any questions in the comments. I'll make sure and respond. And I will put that AirDNA website in the description of the video. So if you found this video helpful, please click like and subscribe. That would help me out a lot. And look forward to bringing you more videos.